Good morning, ladies and gentlemen, and welcome to another episode of The Long and the Short of It by Clive Lambert, Darren Sinden, with a little help from me, Mikhail Onokhov. I hope that all of you are going to have a wonderful, wonderful time today, and I'm very happy all of you made it to this webinar this morning because it's going to be the last two sessions of the year this week on Tuesday and Thursday. And as all the musical stations always give you something extremely good from the last year to listen to, today we'll be having a look on the most interesting, significant events of 2014. But before we do that, and I transfer you to Mr. Darren Sinden, let us have a look at the risk disclaimer. Trading FX and CFDs using leverage may result in loss of all your deposit. Trading losses can exceed all your deposits as well. Not in the case of ordinary markets, okay, though, because at our brokerage, you can always have negative balance protection. I was informed by my colleague that there is some background noise here, so without a further ado, I'm going to transfer the microphone to Mr. Darren Sinden right this very second. Enjoy your webinar.
Thank you, Misha. Good morning, everybody, and welcome to the penultimate episode of The Long and the Short of It for 2014. I hope you've enjoyed the series so far. Hopefully we'll bring a lot of the topics that we've talked about over the last 8 weeks together into today and Thursday's webinar, and hopefully provide you with some thought-provoking insight and some stuff to chew over during the holiday period. So without further ado, let's press on and put the show on the road, as they say. So those of you who are regular attendees to our webinars will know that we look at 3 slides every time we start to try and gauge the mood of the market, to try and pick out key sound bites that have helped inform my thinking and thinking hopefully people in the market generally, and thirdly to try and look at what the big money is thinking about. What are their concerns, what are they doing, what are they acting on at the moment. So without further ado, let's take it the first slide. So mood of the markets. Well, as your regular viewers will know, we try and encapsulate, if I can use that word, the mood of the market in a few phrases and the odd chart. And so I picked out the phrase spooked. And why do I say that? Well, because it's been the most bizarre sort of 24-48 hour period. Those of you that were up late last night, perhaps after a Christmas party, will probably have seen the action that the Central Bank of Russia took over the ruble. Quite bizarre, and very much reminded us of me particularly, and I think other commentators as well, of the events in October 1992 when sterling was forced out of the ERM, something that we touched on in our last webinar on central banks and their role. So spooked, risk off as the markets try to come to terms with the events of recent days. That included a flash PMI number from China first thing this morning, which declined for the first time. Or showed a decline for the first time in 7 months, and that already comes on the back of talk that China GDP growth will be much nearer to 7% than had been previously thought. Santa rally postponed, perhaps, if not cancelled. Now, I wrote that before we'd had the German ZEW numbers this morning, so there was a little bit more optimism back in the European markets, and certainly European equities have bounced off their lows for now, but they've not exactly torn away. The other issue, really, I think that's very much in people's minds, and we'll come on to something akin to this a little bit later on, is cross-asset correlation, and risk is in focus once more. And what I mean by that is, all assets moving in a similar vein, the potential for cross-asset contagion as well, and there has been some very big moves over the last week, and particularly in the last sort of 48 hours. And I think we can see that writ large here in our chart of volatility, the volatility index, the VIX. You can see how that spiked quite substantially over the past few days. We haven't gone back to the highs we saw in volatility by that measure in the mini crash in October, but we have certainly seen a big spike. But you can see for yourself there's in December it's gone from about 11.5 to 21 in a straight line. And so a 75% move or something similar to that, it's 80% move perhaps, and that's been well, you wouldn't have seen that while we had QE. Let's put it like that. QE masked volatility, in my opinion. Obviously, that's finished in these states now, and perhaps markets are that much more sensitive to volatility again. Time will tell, but but keep an eye on the VIX, and do bear in mind that particularly as we finish this week and have a shortened trading week next week, market participants aren't going to be around. Volumes are not going to be what they might be. Volatility and price moves can be exaggerated.
Darren, I was just going to say exactly that actually, but you've said it, so I don't need to. Obviously, the seasonal volumes are a contributor to increase in volatility, and also one other thing to bear in mind is equity markets are in the throes of the sort of rollover as well. You've got the equity indices, the futures rolling off. They've already moved to March contracts, and now the December contract will roll off on Friday. So that also can add to volatility, especially when volumes are low.
Yeah, thanks, Clive. That's a very good point. And actually, just coming back to the idea of volatility and just taking us back to, I think 3 or 4 webinars ago when we talked about volatility, we said that you don't get volatility or peaks, spikes in volatility in a trending market. Volatility, it rears its head or shows itself when trends change, when you have significant points of inflection, so we say, which markets move about, and so the fact that volatility has spiked again suggests that changes are afoot. So a little comment now on some of that. This first piece from MarketWatch today. Wild volatility from Chinese equities over recent weeks has caught the attention of investors around the world, especially after the Shanghai Composite Index 2.31%, and sorry, that's what it was up 2.31% at the time of writing. My apologies. A violent 10 percentage point swing on December the 9th. To close with a heavy 5.4% loss for the day. So net, huge swings in the composite, the broad-based Shanghai Stock Exchange Index, and that move followed an 18% advance in the index during the preceding 2 weeks. So the Chinese market rallied 18%. You might recall that they linked Shanghai with Hong Kong, and investors could move money from one center to the other directly. That was seen as a big positive, and a lot of money flowed into the Chinese market via that new mechanism. But since then we've seen a violent swings to the downside as well. Actually has finished up on the day today. Might be taking that as something of a surprise given the poor flash PMI data, though I think people possibly waiting for the final reading PMI. I also note that foreign direct investment in China actually was up substantially, and that was a very positive number for the Chinese economy. So perhaps there's been some counterbalancing there. The next snippet, I should say, is from Paul Krugman, Nobel laureate economist who writes regularly in the New York Times. A bit of a Marmite figure in the markets, but love him or dislike him, you certainly can't ignore him. And he was speculating about the possibility of no Fed rate rise in 2015. We did touch on that last week when we looked at those inflation swaps, which were suggesting that there wasn't going to be an inflation out to, or very low inflation in the US out to 2019. Paul Krugman said, when push comes to shove, he means the Fed here, are going to look and say it's a pretty weak world economy out there. We don't see any inflation, as we just suggested, and the risk if we raise rates and it turns out we were mistaken is just so huge. And you recall we talked about the Fed not wanting to repeat the mistakes of the 1930s, where they after a period of deflation they tightened rates too early as the economy started to bounce back and were forced to change their mind 6 months later. So they want to get it right, but maybe that means now that we don't do anything, or they don't do anything out to 2015. We shall see. And then a little comment again about what's going on, and one of the trends of the year, emerging market FX and the effect that the strong dollar is having. In recent days, emerging market FX rates fell to decade lows, according to a Bloomberg basket of 20 developing country currencies, driven driven lower by lower oil prices, a slowing China, and fears over Japan's reflation bid. And obviously that's been reinforced by what's gone on with the ruble in the last 24 hours, and we'll have a look at that a little bit closer as we go further into the presentation. So plenty to think about there. One last point which I think I'd like to leave you with. I don't want to just sound like the spectre of doom, but we talked about cross-asset correlation at the top of the show, the potential for for risk to spill over from one asset class to another, and there are fears, genuine fears now over the health of high-yield and junk bonds issued by oil and gas companies for obvious reasons. These bonds were issued when oil was trading at considerably higher levels than it is now. Obviously, a lot of the companies that issued those bonds, their financial planning was based around, if not $100 a barrel of oil, then probably prices in the high 80s. We're nowhere near that at the moment. So there's concern. Are these companies going to be able to meet the payments on these bonds? Will they get paid? Yeah, they were high yield, high risk. So if you bought them, you took the chance that they wouldn't pay. But now that's probably coming home to roost a bit. High yield issuance by oil and gas companies has grown since 2006, and if we look at the chart here from JP Morgan, up until then, to 2004 at least, telecom was principally the largest sector of junk bond borrowers, if I can say that. But in 2005 it was replaced by energy, and that's been the case ever since then. And if you look here, these lines show you how large the sector is relative to its next peer. Energy has remained the largest part of the junk bond market. If you were energy companies, the largest borrowers in that junk bond market, that sector is now 75% larger in terms of its borrowings in junk bonds than its nearest peer, which is healthcare, another highly geared and highly rated sector. The fear is, of course, that quite a few of these junk bonds might now fall over. And that could lead to concerns about high yield borrowing in other areas, but also the fear of contagion to other areas of the market. So contagion risk is a genuine concern now, and also the possibility of another credit crunch. Now this is or at least the seeds that could start another credit crunch. And don't forget, of course, it was a area of high yield speculative borrowing, i.e. the subprime mortgage market, that forced the big downturn last time. So I'm not saying it's definitely going to happen, and I hope it doesn't. But do keep your eyes on stories about this kind of thing, and read the runes, look what's going on, because these are big macro things. We said that they were going to be paramount this year, and I think that's certainly proving to be the case. Right, well, let's get into the meat and the bones of, after all that doom and gloom of the seminar, and have a look back in terms of what happened in 2014 and what did we learn, what can we learn from what we've seen. So we started the year, January, February, with an emerging markets crisis, and that was principally due to the unrest in the Ukraine. It was nothing new, obviously. We've seen political instability in Ukraine across the last decade, but most recently, in turn of this year, protesters who wanted to see Ukraine look more towards Europe and away from Moscow had had enough of the local government. They took to the streets and they forced President Yanukovych from power in Kiev. So say those protesters were very much pro-EU, but in the other side of the country, away from Crimea, away from Kiev rather, in eastern Ukraine, the Crimea, there were people who wanted to look towards Moscow for their future, and they took a completely different view to the guys who were protesting in Kiev. In the end, Moscow annexed Crimea to secure its Black Sea naval base and its access to the Mediterranean, and that was to have far-reaching consequences for Russia, as we'll see later on. The other significant change in those first 2 months of 2014, to my mind, was Janet Yellen becoming chair of the Federal Reserve, the US Central Bank, taking over for Ben Bernanke. She remained committed, much speculation about this, but she remained committed to tapering of QE in the USA, and as we know, in October, the Fed suspended its asset buying program, which I think has got far-reaching ramifications. Precious metals faltered in 2014 despite problems in emerging markets. In fact, gold and silver have had a very tough time of it, and their moves have left many people scratching their heads. Gold peaked at just over $1,392 in late March and started an 8-month sell-off, and a combination really of low inflation, a strong US dollar, which of course is always negative for commodity prices, and the last 9-10 months of US QE combined to depress prices. Silver fell even harder than gold, and of course silver is a metal for which there are a number of industrial uses, and I suspect that silver fell further because of all of the above reasons for gold, but also the fact that there were concerns about global demand generally, not just for silver, but GDP growth across the globe. Most countries are scaling back their growth expectations, and I think silver's fall reflected that. So it fell harder than gold. Is around 12% down year to date. There was a bounce back at the beginning of November. As you can see from the chart on the right, London gold bouncing back from below, London spot gold that is, bouncing back from below 1150. But since then gold has sold off again, and we were testing back towards $1,200 an ounce just before we came on air. So one of the biggest changes, I think, of the year as a whole, or certainly how it would have looked back in March, April time, 2014, were the Indian elections, where Narendra Modi's BJP stormed to victory on a platform of economic regeneration. India has been a bit of, probably of all emerging markets, probably been one of the biggest disappointments up until recent times, because it had so much potential, but unlike China, it failed really to deliver on that and to fulfill a very promising start. So Mr. Modi assumed power officially on the 26th of May. That was the key really for Indian equities to start a 6-month rally, and the Sensex index was one of the best performing markets outside of the USA. In fact, during that October mini crash, it was very apparent that India was sailing its own path. It's relatively unaffected by the sharp dip down in equity markets across the globe. There's lots of hope and expectation priced into India. I think that's the key point there. Thus far, little real action from the government, and I think it's fair to say that markets will want to see something concrete from them across 2015. The currency, the rupee, which started the year on a bullish note, has in the last few days sunk to the lowest levels versus the US dollar that it's seen since January, and the Sensex index is testing back to and through uptrend support, which held in the October mini crash, which we just referenced. Some of my friends who trade from Asia tell me that the Sensex can often be a leading indicator of what's going on in other Asian markets. I suspect there might be a bit of decoupling in that regard of late, but certainly one that I'm keeping an eye on. As you'll see what I mean when we look at these two charts. Here is the Sensex. It clearly starts to pick up as Modi looks like he's going to be the winner in the election. Yeah, the victory's confirmed. He assumes power, a spike higher, and a lovely trend, 45-degree trend up to the right. But look, we draw the line from mid-Feb, touching in 3 places, so I'll at least get a pat on the back from Clive for that. That was the trend support. Here's where it bounced away in October, but this morning it smashed straight through that and was trading sharply lower after the volatility in Russia and the poor Chinese PMI data. And the rupee, well, that started the year strongly, as you can see. All of this is gains against the dollar, and then midway through May there's a bit of an about face, and we've basically weakened considerably ever since. I think that possibly says more about dollar strength than it does about rupee weakness, but this last little bit here, this last leg up, perhaps is now suggesting, or perhaps to me anyway, that is the honeymoon period over for Modi. And if we moved above 63 and the low seen in the middle of Feb this year, then I think it's a big move to make. But then I think we'd really have to have some a closer look at India, what was going to happen there, and that's probably a subject that we'll come back to in 2015. So let's look at some of the other significant events that caught my eye, and I think will be remembered in the annals of history in 2014. Or of 2014, perhaps I should say. Fighting in the eastern Ukraine intensified as the Kiev government moved against Russian-backed rebels, and that fighting leads to tragedy and the shooting down of Malaysian Airways flight MH17 by rebel forces, crowning a disastrous year really for Malaysian Airways, and obviously causing an international furore. The plane was filled with Dutch tourists who were returning home from business or holidaying trips in Malaysia, and relations with Moscow cooled further as an EU sanctions began to bite on the Russian economy. And obviously the Russians and their allies have denied responsibility for that shooting down, but I don't think it's in any doubt, or to most people's minds anyway, that they were responsible for that. Net, that meant pain for Putin's Russia. Obviously international opinion was very much against Mr. Putin. He on the other hand feels he's backed into a corner, so he's not in the mood for compromise. But perhaps to some extent the West feels he needs to be taught a lesson. Somebody said the other day that essentially the price of oil was what brought down the Soviet Union, and I guess we could argue that the price of oil is ultimately what's going to humble the modern version of Russia, or certainly perhaps cause them to think again. And so you can see it here, capital in these two charts. The first one, Russian equities, the CRTX Russia Traded Index. The second chart, the ruble against the dollar. And simply look at this. Just right to left, you can basically equate all of this selling off of Russian equities to capital leaving the country. There's been tremendous capital flight. In the latter part of the year, there's probably been some speculative short selling as well, but initially capital flight. And as you can see, the index trends down. A brief bounce, a brief respite in March. We rally back towards the highs of the year, but as Clive would say, we fail close to the previous high and sell off again. And of course, the real damage is done here. In late November, early December, and the market plunges, towards 1,000, having started the year above 2,000, so more than a 50% fall in the value of Russian equities, rather, by that measure. Same token, if money's leaving the country, then people are selling rubles to buy foreign currency, typically the dollar, and you can just see how the ruble weakens across the year as well. This is a 6-month chart, so we're only looking back to July, but you can see that the curve is upward. We've talked about this before. Breaks above 45. We have that 9% collapse in one day at the beginning of December after the OPEC meeting, but we saw, if you could believe it, an even more dramatic move in the ruble yesterday. The Central Bank of Russia, which had hoped to move to an inflation-targeted free float of the currency, and not to have to intervene, was forced to intervene, and in the end, having raised rates, interest rates from 9.5% to 10% last week, they took a dramatic move and raised rates by a further 6.5%. So that Russian interest rates now stand at 17%. As I said, direct parallels there with what happened when Britain exited the ERM. Interestingly, that there was a bounce back in the ruble from its lows. I think it touched 67 against the dollar yesterday, but it's still trading around 65. Again, just as before we came in here, I checked a few prices. That rate rise may have stabilised it for now, but it also smacks of a panic action to jump to move a rate like that by such a large, by effectively 60% plus. And I don't think it's necessarily the last we'll hear of problems for Russia. And I doubt very much that it's going to do anything to persuade international investors to come back to the country. Something slightly more sedate now. We obviously saw quite a bit of electioneering in 2014, and you know, we had American midterm elections in November. We also saw just before that, at the end of September, a vote on devolution or independence for Scotland here in the UK. That was narrowly defeated. Scots voted to stay within the UK for now, but probably only on the after Westminster politicians were sort of forced into offering greater devolution and greater powers for regional governments here in the UK. That's an ongoing discussion. But there were other you know, political stresses and strains for the UK. The UK Independence Party, for those of you not aware of them, they are a fast-growing anti-European party that's doing very well in the UK. They contested and won 2 out of 3 UK by-elections in September, October. That followed a very strong showing at European elections earlier in the year, and their emergence, it may just be a protest vote, and but certainly putting pressure on both the Tories and Labour, the traditional 2 largest parties here in the UK, and the Tories' coalition partners, the Liberals. And in fact, in one of those by-elections, the Liberal Democrats achieved just 315 votes, I believe, which meant they lost their deposit. Quite a humiliating defeat for the Liberals there. So question marks remain as we come into the end of the lifetime of this Parliament. There's a general election in the UK in 2015. Question marks remain over the existing coalition's government economic record and its plans for deficit and debt reduction. I think when we look back, we'll probably say they didn't do a bad job, but they've tried to talk a better game than they've actually managed to achieve. And so, you know, as we finish the year here and our thoughts turn to 2015 and you know, those first 2 quarters, what's going to happen to cable? I think you can see quite clearly here in the chart of the British pound against the dollar. This is a point probably where investors realised that the UK wasn't going to raise interest rates first. It wasn't going to be in the vanguard of moving away from near zero rates, but also that there was a genuine prospect of Scottish devolution, of Scottish independence, and that itself could have potentially negative risk for negative knock-on effects for sterling. And I think, you know, we can see that what I would probably term as the independence fall here, it spikes down to the mid to low 160s. A brief rally when the independence vote goes the way of people staying in the UK. So we rally here. We sell off again though when it becomes clear that that the Westminster Parliament is going to give away powers to these regional governments, and that we might end up with Scottish independence via the back door. Also a certain amount of weakness again in cable, because of course Britain is still to a greater or lesser degree an oil and gas producing country. We probably import more than we produce these days, but nonetheless there is some effect there. Having said that, investors are not overly concerned, as you can see here. UK 10-year bond yields, that's what the right hand chart shows us. People have been buying bonds for the whole of 2014, and yields on 10-year gilts were north of 3%, around 3.5% at the turn of the year. And by the close of play last night, we were around 1.8% yield. So a very sharp narrowing of yields. People very happy to still to hold UK paper despite the issues that we've already identified. It'll be interesting to see whether that trend continues into the new year. If we are going to enter a risk-off environment for a sustained period of time, then that will be the case. If markets calm down, then perhaps we'll see a bit more of bond prices priced around the expected outcome of that UK general election. And so into the latter part of the year, and we move now into to the events of late October. The Bank of Japan set out its stall. What was it going to do alongside Mr. Abe to try and reflate Japan? Well, what happened was they announced an unexpected, a surprise if you will, massive increase in their QE program, effectively doubling the size of the money that they were going to spend, making it the largest program of quantitative easing ever seen, prorated to the size of the local economy. The yen weakened. I mean, it was like a knife through butter at one point, and it fell to and through 120 to the dollar, just trading just fractionally below 122, I believe, was the low point of the yen then. Interestingly, the yen has strengthened somewhat, and I believe before we came in there we were trading under 117 to the dollar, so it's clawed quite a bit of ground back, but that's not what the Japanese government and the Bank of Japan want to see. Shinzo Abe, as we talked about in earlier webinars, the Japanese premier called a snap election, which we had on Sunday. He and his Liberal Democrat Party will return with a slightly big majority. They rule in coalition with another party. I think I'm right in saying the LDP actually lost a few seats, but their coalition partners gained more. Interesting though that there was a very low voter turnout. I think 53% only of the electorate, those entitled to vote, turned out to vote. I think many people have said though that they didn't bother to vote because there really wasn't any alternative to Shinzo Abe as far as they were concerned. He was the only person for the job to try and force through these economic reforms. So as I said earlier, the fall of the yen is stemmed either side of the election, and in fact, if anything, as I say, there's been more yen strength in the last 2 or 3 days. Despite a very negative Tankan confidence survey, which is the big Japanese national confidence survey, that came out on Monday morning, and for the most part that was negative. Nonetheless, that hasn't done anything to dent the yen strength, and it could just be people covering short positions into the close of the year, or it may be that that people are having a change of thought about 3 hours policies for Japan. So here we are. Here's a chart that sort of potentially encapsulates that. The Nikkei, which of course is extremely closely correlated to the yen. A weak yen has gone hand in hand with a rising Nikkei. From the end of October, the blue line is the Nikkei, the green line is dollar yen, and they've basically been inseparable on the way up certainly, and even now on the way down to some extent. So we haven't seen the yen sell off quite as much. Well, at this point in this chart we haven't. It's probably, as I say, in here now. It's going to be interesting to see what happens going forward. Perhaps the markets are falling out of love with Abe and the 3 hours policy. That again will be a subject that we can look at, and doubtless we'll look at in 2015. So it's been a momentous year, and of course there was nothing more momentous than the move in the price of oil. Brent crude broke below $100 a barrel in mid-September. 1 month later, it was trading below $90 a barrel, and it would finish November at $70 a barrel before further falls. And as we know, over the last couple of days, the price of oil has just been a one-way bet. The big catalyst, of course, was OPEC stepping out of the ring and saying that they weren't going to cut production to try and maintain a stable oil price, and effectively they've thrown the towel in, is how quite a few commentators see that. Falling demand and increasing supply, as I say, make for an almost one-way market in oil, and to my mind, the key to this whole oil equation is that the USA, formerly the biggest consumer of oil, could well become the largest producer. That change isn't going to happen overnight, and I guess the other oil producing countries, particularly the Arab nations, are hoping that the low price will squeeze the pips of shale oil and gas producers. But I think that change is inevitable. The biggest customer will become the biggest producer over time, if not in the next 2 or 3 years. And then the last chart and the last slide for today, and I don't think we keep banging on, as particularly I do, about the change in the basis of oil and the weakness of the price. But I don't think from my mind anyway, I don't believe I'm speaking out of turn when I say that it was one of the biggest macro changes that we've seen in the last 50 years. And I put alongside that the oil shock of the early 70s when OPEC basically came into its own and prices were ramped up by the cartel. I would point to the collapse of Lehman Brothers, which if you like, created the credit crunch, or put it to a head, if you will, and the recession that followed. And then I would add the OPEC meeting of November the 27th, 2014. Those would be my three most momentous macro events of the last 50 years. So there is the chart of both Brent crude and WTI, West Texas Intermediate crude. They continue to fall. We may not have seen the floor yet. Some people are talking about $45 a barrel, certainly for NYMEX. We will see what happens. A slight rally today on that ZEW number, I believe, but I wouldn't think we've seen the bottom yet. Other people may have a different opinion, but I think we'll be returning to the story of oil in 2015. I've taken up enough of your time. I hope that's proved to be interesting and thought-provoking and giving you something to consider. And I will now pass the floor back to my learned colleague, Mr. Clive Lambert. Clive, over to you, sir.
Hello. Yes, thank you very much. Can you hear me, first of all?
Yes, we can.
Yeah. Oh, marvellous. Right, let's see. Let's get one of my screens on the being shown here. Is it that one? Okay. Can you see an oil chart? That's the next question. Hopefully you can see on screen a chart for WTI, and I'm going to start where Darren left off, which is that actually today WTI hit $55. This is the West Texas Intermediate NYMEX light sweet crude, whatever you call it, CLF, US crude. There's lots of names for it, but what it is what's happened here is that it has sold off from $102 in June to $55 today, and yeah, obviously a massive move. There was actually a consolidation halfway through that move in October, and when we broke that consolidation pattern back in October, when this was at $80, I said to my clients, this could go to $55. And we did this in one of the webinars the other day, didn't we? We talked about these consolidation patterns. There is a small symmetrical triangle on our chart, and if we class that as halfway through the move, and the first part of the move was from 102 down to 78. When we broke that consolidation at $80 in early November, I think it was, that was when I started running around telling anybody who'll listen that oil's going to go to $55. And lots of people were looking at me like I was completely bonkers. And here we are at $55. Now, I'd like to put that into some context, actually. And I'm going to do that with my slides. And I'm going to go out of order with my slides. I'm going to skip through and go to that oil chart, because I'd like to put this into some context. This is 2004. This is a monthly bar chart for oil since 2004, when we were trading at $30, and by 2008 we'd traded up to near touching $150, and then within a year we were trading down at $35. And this is the Brent crude. This is the UK benchmark, if you like. We then saw a significant rally, and now we're seeing this sell-off again, now that $100 seems to be a foggy memory. Okay, obviously our consolidation doesn't show on that, but what I think this chart does show is that everyone's getting very excited and stressed, and whoa dear, you know, the world's about to end because oil's at $60. Yeah, okay. You know, back in 2008, it went from 147.50 to 35 in 1 year. So it's capable of more. I've actually got the target for Brent crude still a little bit lower. I am now going to go back. I'm going to press escape there. I'm going to go back to the start of my slides. I've decided, ladies and gents, to do things a little bit differently to Darren today, because as far as the charts are concerned, it's easier, it's better for me to, if you like, look at what happened in 2014, yes, but then to also, go straight on to what happened in what the charts are suggesting may happen in 2015. And just a small disclaimer here, if we like, which is I can show at the end. I am going to be expressing some opinions today. The opinions are of Futures Techs, which is my business, and not of Admiral Markets UK. I have an FCA registered business, which is registered to give investment advice, so I'm okay to give you a few views, and that's the disclaimer out of the way anyway. Right, so first of all, and so today I want to look at bonds, equities and commodities, and tomorrow, Thursday, sorry, we'll look at various FX markets and FX pairs and what the bigger picture charts suggest for those. And actually I was quite pleased to have done this exercise, and I always enjoy year end on the basis that it allows me to sort of take that step back and have to look at the bigger picture, which is exactly what I am doing. So, bond markets, biggest bond market in Europe, or the most widely watched benchmark, if you like, is the Bund future. Lots and lots of trade going through in that every day. Lots of people looking at that particular futures market, benchmark for European bonds. Bunds spent most of this year going in one direction. That is the chart for Bunds. It's a very neat channel, with both the highs and the lows hit several times. It's been a reasonably simple thing to keep an eye on. There's a thing on Twitter I've seen and on various things over the years. It's when Bart Simpson's writing on his blackboard in the opening credits of The Simpsons, and somebody did this one where it said, "I must never sell buns," and I've always thought, certainly throughout 2014, that has been extremely relevant, if you like, and I would not argue with that sentiment whatsoever. Never sell buns. It's been a reasonably safe thing to stick to, and so what's the projection for that going forwards? There's no reason really to change our views on that. No reason to stick to to veer from a bullish path. Obviously, there is one thing that is looming, and that is that actually yields, because with bunds priced as they are, they're only yielding around 0.5%, and obviously how much lower can yields go? That's a question that probably Darren may be better suited to answer than myself. What I can say from the charts is that that there is still upside. I'm going to skip between my slides and the charts that I was looking at yesterday to prepare. That says to me 155 and 155.50, 155.70. 157.00 are the immediate upside targets for Bund futures, and I see no reason to at the moment to bat against that trend. It's this is high, the RSI is high, but it's been high before and stayed. It was high there, which was from here all the way through to here. So just because RSI is high doesn't mean you sell. And I think it's hopefully by now, with the amount of with the number of webinars we've done, hopefully the regular attendees are starting to saying these things and you're understanding them, because we've sort of gone through a lot of these methodologies and terminologies. Is that
Clive, yeah. So just you asking about how low can yields go? They can potentially go lower, and indeed very likely would if we did see QE in the eurozone next year. And obviously, that's exactly what would happen if the ECB started buying German bunds. So another European bonds, but and I guess if we look at Japan, well, rates can go to, yields on bonds can go to effectively zero. So
And Switzerland, negative
yeah,
yield.
exactly. Yeah, exactly. So we could find ourselves in a very strange place if that happens. But anyway, I won't
Indeed.
interrupt you anymore.
Indeed, I mean it's just one of those classic examples, really, for me, of the old phrase that the trend is your friend, and it's really not. It's been one to not bat against at all throughout throughout 2014, and for now, I see no reason to rethink that, and we'll watch that channel. And if that channel was to break to the downside, then okay, maybe that's our seismic change that we've been looking for. But at present, no, it's yeah, we'll stick to our trend is your friend caveat, if you like. This is the T-notes, and T-notes are 10-year bonds in the US, and we can see that 2014 again, which starts somewhere around here. This is a weekly candlestick chart, continuation chart, and that has again seen a reasonably steady rise in price, so a fall in yields over 2014. There was a bit of a mad wobble type event that went on in October, and I'd actually think that that's destabilized the markets a little bit. Some of the markets, some of the money market products that I look at regularly have felt what's the word? Almost unstable and a little bit uncertain, and they haven't behaved as well as I'd like since that event. Actually, they've been misbehaving a little bit, which has been a difficult thing to navigate. But that's the challenges of we all have challenges in our work, and that's been one of mine of late. Generally, fixed income markets are chart pretty nicely and behave, if you like, but these markets have been a little bit wobbly on their feet, if you like, since that event, since that sort of extreme event happened in October, when the market price spiked up viciously, 3 whole points in one day, and then all the way back again. Is pretty nasty stuff. There was a lot of talk that the algorithmic trading machines turned off during that time, and that some exchanges crashed and stuff like that. It was a nasty period, really. That's actually, I think, has undermined some of the confidence in the markets, if I'm completely honest with you. So let's move on to equity markets, and as me and Super Daz are both based in the UK, and Admiral Markets is UK, is who we're doing this for. Let's look at the UK equities first, and we've got the FTSE 100 index. This is the futures, 1-month futures, and this is a chart going back. Actually, I think this chart might span my entire career in the city. It actually starts off the far bottom left of the chart. Here is when I started in the city, early 1986, sometime around then. And you can see, actually, the first thing, one of the early things that happened in my career was the crash of 1987, which turned out to be one of the best buying opportunities in living memory, really, anyone's living memory. Go on, mate.
I was going to say, I'm assuming that was just an unhappy coincidence.
Well, let's hope so, mate. Yeah, exactly. I'll tell you what it did do actually for me. I was working in stockbroking, and I think it got me. Yeah, I always expected the unexpected from that moment onwards. I think it was a really good thing to happen in your early formative years of your career, to see. I mean, I think there was guys that I was working with then who just went, what the hell's going on? I've never seen anything like this before. And so throughout my career from then onwards, I always sort of just took these kind of things almost with a sort of melancholic shrug of the shoulders. And you could see from that chart that we've had plenty of things, plenty of volatility since then, and what we've actually seen is the market getting up to 6,995 on the last days of the last millennium. There was a lot of dot-com bubblicious stuff going on here, and then we halved. We halved to 3,400 by 2002-3, and then we got it all back again. 2007-8. Market rallied all the way back up to 6,800 and then gave it all back again, which was the obviously the subprime crisis, and a lot of banking stocks in the FTSE getting absolutely smashed, smashed to bits on that. Then we rallied all the way back up again, and we hit 6,800 this year 2 or 3 times. Last year once, this year 2 or 3, 4 times. Can't get through it. Just can't get through 6,800 to 6,900. And I mean, Darren will back me up on this. The index back here, the composition of the index, the stocks that were in the FTSE 100 at the end of last, the end of 1999, is so different to what's in there now. It's almost a completely different index as far as the composition is concerned. It was very UK centric here. It was very tech centric, because there were firms like ARM Holdings and BT that were doing extremely well in this period. Around this period, the miners were doing well, the banks were doing well, the banks weren't doing very well down here. Now it's back to being a global, almost like half of it's a global mining index almost. It's so different to what it was. But this is exactly, I think this proves that technical analysis and levels and looking at charts needs to be taken seriously, and needs to and has a say, because actually, why isn't it getting through 7,000? As far as I'm concerned, it's psychology. It's pure psychology. So we've got this big problem in the FTSE: 6,800, 6,950, 7,000. It's just, we just can't clear it. I think we will next year. I think next year we clear it. And then, so I'm looking to see where we can go from there. And one thing that I haven't touched on in our webinars yet, one thing that technical analysts like myself use when markets are making new highs and never been seen, at levels never seen before, we look and look. That chart looks confusing. It is confusing. There's a lot of lines on there. Okay, that's why. Yeah, just leave it to me. Don't worry about it. What we do is put a lot of Fibonacci lines on there. They're extension lines. They're using the Elliott wave theory, and we're trying to find clusters where some of these lines come together to say that could be a big resistance area, that could be a big resistance area, etc., etc. And what that tells us is that 72.50, 72.00 to 72.50 is an area of resistance. And so, really, if and when we get through 7,000, we could go 7,250 very quickly. If we, then we've got 75.50 to 75.80, and then there's another cluster up around the 8,000 mark. Now, it seems strange for me to be talking about the FTSE getting through 7,000 when it's down at 6,200, but actually, but we've had a very swift decline in the last week, and it's been a very light volume, as was the rally through October actually. So I just think I'm not too worried about this pullback that we've seen lately. I think we're going to see buyers returning, particularly in the States. None of it looks like a top to me. I think we need one more blowout, and it could be that this FTSE smashing through 7,000 next year could be the biggest sort of false signal ever. We could get to one of these levels that I'm talking about, one of these extension clusters, and then just fall over and not see those levels for a long time. That is one scenario. The DAX index actually did get through a massive resistance this year, and was it this year? Let me got myself worrying now. Let's have a look. Let's have a look at the actual chart. Right. Okay. Actually, it was it was last year, but we stayed above there this year. We pulled all the way back in October. That low in October, 83.50, was a hold of the broken resistance. Look, here's that. Sorry, let's go back to this one. Look, there's the 1999 high, 82.50. There's the 2007, 2007 high, 82.50. Get through it last year. Trade up to, we've hit this magic 10,000 mark, which everyone was hooping, yahooing and da-da-da about. And then we had the big pullback in October. It held the broken resistance. It held it. And that's still a bullish chart for me. As long as we hold that 82.50 area. And I'm now applying some of the things that I talked about in previous webinars, and we've been talked about them in shorter term time frames. I'm just applying them to monthly charts and doing the same sort of thing. Resistance turns support. The uptrend continues. That's where we're at. DAX futures have traded down to 92.16 today. That's still 1,000 points away from this danger zone, if you like. Nothing to worry about. And the DAX has been travelling in the channel through that period as well. And the DAX, once again, we can do this measuring thing with the Fibonacci extensions, and we can say that there is a big area around 12,000 for the DAX that it could go and see sometime next year if and when we get through 10,127, which was this year's high. So yes, right now at this very moment as we speak, equity markets are selling off, but I do believe that I've got a bullish outlook for next year unless we start to see some major support levels broken in the coming weeks and months. The Euro Stoxx 50 is a very different looking chart, and there was a lot of German and Italian banks that made this index up back here, and that was the reason why it got absolutely smashed to pieces. And I'll tell you what, the reason the Euro Stoxx 50, if people haven't heard of this, it's one to watch. It's something you should be watching. It is a very well watched benchmark by professional traders. It is a sort of pan-European index that is a very good barometer of what's going on in Europe. And you can see there we are a long way away from the 1999-2000 high, which was 5,525. We only reached 4,500 in 07. 1,700 to 2,000 is always a strong support by the look of things, and now we've sort of got this very wide channel that's been sort of defining that for a while, and that's the shorter term weekly chart. And the title I've put for that chart is that this is not what a top looks like, and that's, I believe that we've got at least one more push higher, and what we're seeing recently is not top of the market. The S&P 500, the channels are still having their say. We did see obviously the big blip through there in October, but it came back very quickly, and again we are seeing a bit of a blip lower in that one now. In fact, we're trading 1977, so we might be slightly below that channel line as I write, because as I write, we've got new lows in the S&P for the day, and bunds are flying higher. Markets are crazy at the moment. So, last thing to look at, commodities. Gold. I think we are going to see gold at $900 next year. There's a lot of reasons on the charts to think that gold is due a corrective move all the way back down to $900. When will I be wrong? If we can get above 1280 and 1310 is when I have to put my hands up on that bigger picture call and say, actually, nah, that's the charts. The chart has changed, if you like. And Brent crude, we've already, we started off. I did things the wrong way around. I started off by looking at Brent just to segue in from Big Bad Darren's chatter on that one. And again, as I'm looking at my other screen, we're making a new low for Brent crude. This has been one of my best calls of the year, actually. I can tell you that this was, let me just show you a couple of things just to sign off. This was my Brent crude report on the 2nd of July. And this is something we call our skew bars. and we said the market was bearish after it broke 1280 on the 2nd of July. And then this was the 4th of November. There is a measuring technique. We've talked about these in the webinars. I've shown you how this works. Assuming the consolidation is halfway through the big move, that suggests we can head to 62.79. That's for Brent crude. And in the WTI, in the American version, if we do the same measuring thing here as we did in Brent, we get a downside target of 55.12. We've hit that target. In the Brent, we've hit that target. I've done some revised targets on that since, because I'm actually using the daily chart, and this suggests that actually we could go down to $53 for the Brent measure. So this, according to these charts, which have been very reliable and have called these moves beautifully for us, there's still some more to go. Actually, last trade, Brent crude 58.78, making new lows as we speak. It is still going, so yeah, we're getting on to we're down here now. I put these slides together a day or two ago, so still going, Brent crude, and still got downside potential. Thank you very much indeed for listening. Hopefully that's some insight there. It's quite amusing. I think I'm amused that while I was talking about equity markets rallying, they've had a big sell-off in the 10 minutes I was saying that. And other things, gold's going down, but no, it's going up. But at least the bonds are going up, so that's going in the direction of what I was saying. But obviously, bigger picture calls for this year. I shall pass you back to Misha and bid you all farewell, and me and Darren will be back here, ready and raring on Thursday. Cheers.
Thank you very much, Clive. Thank you very much, Darren. A very insightful, very interesting webinar indeed. To all of you who want to participate in our last session of the year, it will take place this Thursday. We'll see you there. Good afternoon. Have a nice week. Bye-bye.